Hey, welcome back. Now that we got to about 40 companies that we looked into in the series, I decided to do this kind of recap with some of the companies that I might buy relatively soon. I'm not buying right now, but given the current market with fear of a recession, rate cuts, tech rotation and everything, they are getting to very interesting levels. They are all going to report earnings relatively soon, and maybe after that I'll think about opening a position and then develop it in time. Number 1 is gonna be Celsius, an energy drink company that offers a healthier option than the regular drink. Despite being a small company, they managed to get a very significant market share, currently being the number 3 in the US with some incredible growth. There is a ton of noise in the market right now with studies showing a potential weakening demand or potential lawsuits and so on. This is in fact how we got to the current price. Now look, if you look into the studies that they have behind the claims, it isn't some significant discovery or something. You know, they are either paid or the results aren't the most conclusive and stuff, which is the norm wherever you have studies. It's a whole industry around it. They have ingredients that do what they are supposed to do, especially if you combine them with working out and dieting, for example. It isn't some magic formula. Now, some claims might be a bit too much, like the no preservatives claim that led to them losing a lawsuit. So this is a risk to keep in mind, especially when probably every competitor is paying very close attention to them and I guess is ready to sanction them whenever they get the chance. The news about the weakening demand and stuff, I really don't think it's that important. You know, it's probably a short or medium term thing and it would affect everyone, some potentially more than the others. What I like about this company more than Monster, which I looked into recently, is the potential to grow. Monster is everywhere with a ton of brands, while Celsius just began leaving the US. Just think about the potential coming from Europe or Asia, for example. And then think about the potential to bring secondary brands or products into the mix. Celsius, the energy drink, can be just the first step. If they can grow even at 20% per year, which should be small during a massive global expansion, this can still do very good, but it's ultimately a matter of the market's expectations. If the market expected, let's say 25%, delivering very solid 20% growth rates would make it crash significantly. Monster is traded at something like 30x the cash flow, and even if they are growing pretty well, it's much less than what Celsius can do. But I think Celsius still has to prove some cash flow potential to gain more market confidence, because with Monster, you know that they can make 1 to even 1.5 billion today. If they can make 300 million, they would be at a similar ratio to Monster, even if they have much more potential to grow. I see the two as Nike and Lululemon, which I'll cover in a second. Financially, they are in a really good position, with the current assets covering the total liabilities about 3 times and 0 debt. With close to $1 billion in cash and potential to get some debt if needed, it would be very tough to mess up the international expansion. Another thing, don't forget that Pepsi has some convertible preferred stock that they got as part of the distribution agreement. Now, this has potential from two sides. One, the distribution agreement with a giant is a huge thing for a small company, and we can see its effect on Celsius recently with all the growth. Plus the massive potential it has to boost the upcoming international expansion. The second thing is the potential for Pepsi to buy them. I could see the distribution agreement as a test, and now that they've proven how much they can achieve, Pepsi could easily afford to get them. If they get into a fight with Coca-Cola and Monster for them, for example, this can easily be a multi-bagger. But even without them, this has real potential to be a multi-bagger. You know, in half a decade, if the expansion goes okay and they can develop some secondary brands, which they already have, this can continue to deliver some massive growth. But you know, the market will continue to focus on the short term, and this is how we got to a potential buying opportunity now, in my opinion. That's not to say there isn't risk, however. They can mess up the expansion completely and it can be a huge waste of money, or the product can lose popularity, or there is some lawsuit with Pepsi or something, so things can go bad. But if there isn't some kind of big issue, I think this can do very well, so the risk and reward looks very good for me. By the way, I'm now a Moomoo affiliate and they have some really nice sign-up bonuses, and the overall platform is very competitive. You can get up to 15 free shares depending on how much you deposit, plus a very attractive interest on the uninvested cash, so if you're interested, check out the links below to see if you're eligible. It's a nice way to support the channel while also getting some benefits. Overall, I like the company and I'm really considering buying. Very good financials, huge potential to grow, and if they continue to fall, this can become a very attractive option. There is risk, but comparing it to the potential reward, I think this is a good one for me. All the short-term focus from the market can open some very nice long-term opportunities, and there are more stocks in the same situation, as you are about to see. I think this has very high chances of seeing a company like Pepsi buy them, especially if they can execute the global expansion well. If we then see Monster, Red Bull, Coca-Cola and so on fighting for them, the potential from the current price is huge. And again, even without it, this can do very well on its own. Now, UIPath, this is a company that, simply put, makes bots to automate all the repetitive things that go on in a company. What they do is not new, I mean, they've been doing it for close to 2 decades now, but this type of automation, especially with AI, can be part of pretty much any company in the future. You can use this for invoices, inventory management, analytics and a lot of things, which can save you quite some money and especially time. They are still a very small company, making something like 1.3 billion in revenue, which more than doubled since 2021. But they got into some issues which they blame on the environment, and the growth fell significantly together with the stock price. This, together with a potential rotation from tech and the rate cuts on the horizon, can lead to an opportunity in my opinion. Financially, they are in a very good position with enough cash to offset all the liabilities plus a ton of marketable securities. Over half of the liabilities is in deferred revenue, so basically payments in advance, they don't have to pay it in cash. I'd like to see them do more with that money, to be fair. It's over $1 billion that sits there and doesn't even generate interest. Even 5% on that money is 50 million per year that they are missing, so it can make a difference. Do they really not have anything better to do with it? Okay, keep $500 million in cash for maximum safety, but do something with the rest. They recently had to fire people to adapt to the weakening environment. This comes as they gave a weak guidance for the year. Now, if it's just a temporary thing that has to do with the high rate environment, that's not really an issue, but what if it isn't? The thing is, this is impossible to predict, so more uncertainty combined with the rotation from growth and especially AI to dividend or value, you get to the current price. But AI and all the automation that we should probably see more in the future has the potential to really boost this company's income. They made around 290 million in cash flow a year ago, placing them at a ratio of around 24, which isn't that good, but it's relatively average for a company like this. But they are on track to get to something like 400 million per year, which would be a ratio of around 17.5. Anyway, with this type of company, you don't buy them for what they can do now, and getting a potentially high growth company for 20x the trailing cash flow is often quite a good price. Because think about it, if they grow at only 12%, which would be a significant drop, then they would make something around 700 million in half a decade, so a ratio of around 10. Then they can do some massive buybacks or pay dividends or do whatever they want. They already do some buybacks, which is a good price in my opinion. This could also attract some company to buy them. Pay let's say 10 billion and get a company with pretty much no debt and something like 2 billion in cash and securities that can make 700 million per year and has potential to grow. What I don't like about them is that they pay huge stock-based compensation. It could be because of all the recent CEO changes and rechanges and stuff, but still pretty high. But it can also be an incentive, and if they can manage to grow even at 12%, that should be okay. As a note, they plan to adjust the compensation structure due to the environment, so that's at least a positive. However, what if they keep growing at something like 15-20% instead? That would get them to 800 million to even $1 billion, so in half a decade this will very likely not remain at 7 billion. If they remain at 20x the cash flow, that's 16 to 20 billion, meaning roughly a 2-3x. But if they get to the common 30-40x that we see tech companies normally traded at, this can even be a 4, 5, 6x. Again, no debt to worry about, so maybe with lower interest rates this could be achievable, especially if they get a bit of debt when the rate is lower. I think from this price it wouldn't take much to see them do well, and they are priced for pretty bad results. Now, is it a clear buy for me? Well, it's not a terrible price, but maybe if they fall to like 8 to 10, I'd say yes for sure. The margin of safety in that case would be really nice, and to this you add the balance sheet and the potential, and I think that would be a good level to start a position. Again, no debt to worry about, sitting on a ton of cash and with a lot of room to grow. Now, Lululemon, this is an apparel company offering pretty high quality products. They are kind of a mini Nike, but they don't focus on shoes nearly that much. We can see very impressive margins, with the EBITDA margin being almost 2 times bigger than Nike's, which is quite an achievement. Plus, all the current ratios are even better than the 5-year average, so even during an expansion they kept doing better and better. You can see them having a pretty perfect growth scorecard on Seeking Alpha, which is quite a rare thing to see. By the way, check the description if you want a $25 discount on the annual plan. They have a plan to double the $6.25 billion in revenue they've made in 2021 by 2026. To do that, they want to quadruple the international revenues and double the men's and digital revenues, which is quite doable and they are on track to achieve it. Now, this is not a small company, they are valued at around 30 billion, so about a quarter of Nike. But they've been more than doubling the revenue since 2021 and the free cash flow is getting significant, even during an investment cycle. Right now, they are at a price to free cash flow ratio of less than 20, which is similar to Nike after it fell by like 60% from its peak. However, similar to Monster and Celsius, Lululemon has much more potential to grow. Valuing a high growth company the same as a high quality but slow growth cash cow doesn't seem right. The 5-year average growth rate is something like 20 to 25%, but even at a 10-12%, this is pretty cheap in my opinion. And with so much international potential, they can even beat the average, so seeing it traded at such a low expectation is very interesting. My issue with Nike is the limited potential to grow and what they do about it. They are a solid cash flow producer, but they seem to be focused on growing the EPS through buybacks rather than actually developing the company. We can see the revenue growing from 44 billion in 2021 to 51 billion now and basically zero growth expected this year. Add Lululemon and many other brands developing and you can see them stagnating or even declining in the future unless they do something, and don't get me wrong, they have the resources to do it. They just need the right management, which I'm not sure they have. Back to Lulu, about 80% of the company's revenue comes from the Americas, so Europe, Asia, especially China, can offer a lot more potential to grow. Even in the US, this isn't such a big competitor compared to Nike. So you can see how they are very similar to Celsius, although in a much bigger industry and I'd say in a different stage of the expansion. Financially, this is also in excellent shape. The current assets are well above the current liabilities and once again we can see basically no debt. You get around 4.2 billion in equity on a market cap of around 30 billion, which is pretty normal for the industry. Unlike Celsius, however, having another company buy them isn't that likely. Again, 30 billion is a ton of money even for Nike, and that's pretty much the market leader. I mean, if Nike really wants some noticeable growth, they could buy them, but it would take a lot and there is the risk of it not even being approved. With Celsius, you have Coca-Cola or Pepsi, which are 30-40 times bigger and would barely fill the cost of the acquisition. But they don't need another company to buy them to do well. Again, international expansion plus further development in the Americas can make this a multi-bagger in, let's say, a decade from now. Add the excellent balance sheet and even at a 10-12% growth rate, this is pretty cheap in my opinion. You pay basically the same as you do for Nike now, but they are kind of Nike some decades ago. So overall, 3 very high potential companies that I'm paying very close attention to. I think all 3 can easily be multi-baggers, especially if we see the prices fall even more. What they have in common is the potential to expand plus the very good financial shape. Add rate cuts, potentially facilitating an optimal environment for an expansion, and you can see how they can do very well. They will relatively soon report the latest earnings and maybe after that I'll make my decision. The current prices aren't bad, but I generally avoid buying before an earnings report because it can be very volatile and I'd get more information. There are a few more companies that would qualify as a potential buy, but I wanted to include the ones that are either very close to or already a buy for me. Plus, I didn't include stuff like AMC Networks or Alibaba because I already made a full stock analysis about them recently, so make sure to check them out as well. I want to do this kind of recap every 10, maybe 15 videos, because this way I also get kind of a reminder to check them again. Let me know if I might have missed anything important and make sure to leave a like. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.